Welcome back to Stocks and Trades channel. We provide easy to digest information in short videos about stock market investing, personal finance, money saving, and building wealth. Our content is designed to help you achieve financial freedom sooner. Today's video will provide news, insight, and investment suggestions on the week ahead. We'll analyze 2+1 stocks to watch this week and some others that will be volatile. So, let's begin. Disclaimer. All trading involves risk. Only risk capital you are prepared to lose. Past performance is not an indication of future results. This content is for educational or entertainment purposes only and is not investment advice. In a holiday-shortened week, the three major U.S. stock indexes again posted negative results, with the Nasdaq trailing the Dow and the S&P 500 by a wide margin, just as it had the previous week. A handful of major U.S. banks kicked off earnings season with mixed results. Overall, the biggest banks are expected to suffer from difficult year-over-year comparisons to the big profits they reported earlier in the recovery from the pandemic. As of Friday, analysts were forecasting that first quarter earnings for banks in the S&P 500 fell 37% from a year ago. Our first stock type is dividend earning stocks. These are a great way to earn passive income. This week's suggestion is Realty Income, with ticker symbol O. Realty Income, the monthly dividend company, is an S&P 500 company dedicated to providing stockholders with dependable monthly income. The company is structured as a REIT, and its monthly dividends are supported by the cash flow from over 6,500 real estate properties owned under long-term lease agreements with our commercial clients. To date, the company has declared 608 consecutive common stock monthly dividends throughout its 52-year operating history and increased the dividend 109 times since Realty Income's public listing in 1994. The company was founded in 1969 and is headquartered in San Diego, California. Sumit Roy has served as Realty Income's Chief Executive Officer since October 2018 and President since 2015. Some technical analysis data shows that Realty Income return on equity is 2.3%, its average volume is about 3.86 million, its market cap is $43.41 billion, its beta is 0.8, its PE ratio is 83.75, its PEG ratio is 3.02, and its EPS is 87 cents. Our rating is 9 and we consider this stock as a moderate buy. Based on experienced analysts offering 12-month price targets for Realty Income in the last 3 months, the average price target is $78.99, with a high estimate of $90.30 and a low estimate of $69.69. With current price at $72.61, this would mean almost 8.8% average profit over the next year. Realty Income pays an annual dividend of $2.88, which amounts to a dividend yield of 3.97% and a dividend growth of 3.56%. The Exdividend date is the 29th of April, so buying a Realty Income stock by then will pay you $0.247 on 13th May. Realty Income is one of the classic dividend aristocrats, which is an elite group of dividend payers that have a long history of annual dividend hikes. Realty Income develops single-tenant properties under a triple net lease arrangement, which pushes most of the costs such as taxes and insurance onto the tenant. These leases are generally long-term and have automatic rent escalators. Most real estate investment trusts struggled during the COVID-19 pandemic as many businesses were shut down, leaving tenants unable to come up with the rent. Most of Realty Income's tenants were considered essential businesses and permitted to remain open. The typical Realty Income tenant is a drug store, convenience store, or dollar store. These businesses are also highly defensive in that consumers will still buy medications and snacks no matter what the economy does. When many REITs cut their dividends in 2020, Realty Income raised its dividend 3 times. Realty Income has been such a steady player with a solid business model, it should be a core holding of an income investor's portfolio. The above analysis is not exhaustive and just presents you some important insights. We suggest using this analysis and carry out your own detailed research before taking a decision to open any position. Our second stock type is growth stocks. A growth stock is a share in a business that's shown above average earnings and has the potential to grow faster than the overall economy. This week's suggestion is Crocs, with ticker symbol Crocs. Crocs Incorporated, together with its subsidiaries, designs, develops, manufactures, markets, and distributes casual lifestyle footwear and accessories for men, women, and children. It offers various footwear products, including clogs, sandals, slides, flip-flops, boots, flats, wedges, platforms, socks, shoe charms, loafers, sneakers, and slippers under the Crocs brand name. The company sells its products in approximately 85 countries through wholesalers, retail stores, e-commerce sites, and third-party marketplaces. It had 193 outlet stores, 107 retail stores, 373 company-operated stores, 73 kiosks and store-in-stores, and 14 company-operated e-commerce sites. The company serves in the Americas, the Asia-Pacific, Europe, the Middle East, and Africa. The company was founded in 2002 and is headquartered in Broomfield, Colorado. Andrew Rees joined Crocs as president in June 2014, and became chief executive officer in June 2017. Some technical analysis data shows that Crocs' return on equity is 276%, its average volume is about 1.81 million, its market cap is $4.43 billion, its beta is 1.85, its PE ratio is 6.35, its PEG ratio is -31.83, its EPS is $11.39 and its asset growth is 38.11%. Despite our rating as 7, we consider this stock as a moderate buy. Based on experienced analysts offering 12-month price targets for Crocs in the last 3 months, the average price target is $160.01, with a high estimate of $258.30 and a low estimate of $80.80. With current price at $72.32, this would mean about 121% average profit over the next year. Crocs has exhibited a bullish run on the bourses in the past year. Crocs has been gaining from solid consumer demand as well as broad-based growth across all markets, channels and categories for a while. Increased focus on product innovation and marketing, investments in digital capabilities and potential gains from the Hey Dude buyout were also positives. Clogs, sandals and gibbets act as key drivers for this one of the leading footwear brands. Crocs has been benefiting from its expanded digital and omni-channel capabilities for a while. Increased focus on the Crocs mobile app and global social platforms aided digital sales. Within digital, all regions witnessed double-digit increases from the year-ago period's tallies. Gains from strategic collaborations, influencer campaigns plus digital and social marketing efforts remained upsides. The above analysis is not exhaustive and just presents you some important insights. We suggest using this analysis and carry out your own detailed research before taking a decision to open any position. Our third stock type is blue chip stocks. These are typically large, well-established and financially sound companies that have operated for many years and that have dependable earnings, often paying dividends to investors. This week's suggestion is Caterpillar, with ticker symbol CAT. Caterpillar Incorporated manufactures and sells construction and mining equipment, diesel and natural gas engines, and industrial gas turbines worldwide. Its construction industries segment offers asphalt pavers, backhoe loaders, compactors, cold planers, compact track and multi-terrain loaders, excavators, motor graders, pipe layers, road reclaimers, site prep tractors, skid steer loaders, telehandlers, and utility vehicles, mini, small, medium, and large excavators, compact, small, and medium wheel loaders, track-type tractors and loaders, and wheel excavators. The resource industries segment provides electric rope shovels, draglines, hydraulic shovels, rotary drills, hard rock vehicles, track-type tractors, mining trucks, longwall miners, wheel loaders, off-highway trucks, articulated trucks, wheel tractor scrapers, wheel dozers, fleet management, landfill compactors, soil compactors, machinery components, autonomous ready vehicles and solutions, select work tools, and safety services and mining performance solutions. The energy and transportation segment offers reciprocating engines, generator sets, integrated systems and solutions, turbines and turbine-related services, remanufactured reciprocating engines and components, centrifugal gas compressors, diesel-electric locomotives and components, and other rail-related products and services for marine, oil and gas, industrial, and electric power generation sectors. The company's financial products segment provides operating and finance leases, installment sale contracts, working capital loans, and wholesale financing plans, and insurance and risk management products for vehicles, power generation facilities, and marine vessels. The all other operating segment manufactures filters and fluids, undercarriage, ground engaging tools, etc. The company was founded in 1925 and is headquartered in Deerfield, Illinois. Jim Umpleby became the Chief Executive Officer of Caterpillar in January 2017, and Chairman in December 2018. Some technical analysis data shows that Caterpillar's return on equity is 38.9%, its average volume is about 3.88 million, its market cap is $122.08 billion, its beta is 0.94, its PE ratio is 19.26, its PEG ratio is 1.77, its EPS is $11.83, and its return on capital is 11.8%. Despite our rating as 6, we consider this stock as a strong buy. Based on experienced analysts offering 12-month price targets for Caterpillar in the last 3 months, the average price target is $239.70, with a high estimate of $304.50 and a low estimate of $165.64. With current price at $227.81, this implies a 5.22% upside potential over the next year. The company is best known for its construction equipment, so the link to infrastructure investment is obvious. However, a breakout of Caterpillar's profit in 2021 shows the combination of resource industries and energy and transportation generated $350 million more profit than the construction industries segment. It's not just about construction equipment and the commercial/government/retail construction market that drives Caterpillar's sales. If the world is going to step up investment in mining commodities, energy, and rail networks to support infrastructure development, then Caterpillar is likely to be a winner all around. In tandem with the underlying trend of infrastructure investment, Caterpillar also has the potential to benefit from a possible long-term upcycle of investment in the mining and energy industries. The above analysis is not exhaustive and just presents you some important insights. We suggest using this analysis and carry out your own detailed research before taking a decision to open any position. Next week, many companies are going to release their earnings reports, which is one of the most potentially volatile times of the year for equities, and if we are not careful enough, we could put our entire portfolio at risk. Companies may announce earnings or losses and stock prices may go up or down significantly. For this reason, we suggest that you avoid or carefully consider opening a position for the following stocks during next week, and wait to evaluate the earnings announcement before deciding to invest. Bank of America, the Bank of New York Mellon Corporation, Synchrony Financial, and the Charles Schwab Corporation will release earnings on Monday, 18 April. Johnson & Johnson, Netflix, Lockheed Martin, Prologis, IBM and Hasbro will release earnings on Tuesday, 19 April. Wednesday, 20 April will be the most popular day of the week as Tesla, Procter & Gamble, ASML Holding, Abbott Laboratories, Equifax, and Globe Life among others will release their earnings on this day. Danaher Corporation, NextEra Energy, Philip Morris International, the Union Pacific Railroad, AT&T, and Blackstone will release earnings on Thursday, 21 April. Finally, Verizon Communications, American Express, SAP, HCA Healthcare, and Kimberly-Clark Corporation will release earnings on Friday, 22 April. Watch these stocks' prices carefully and think twice before making any decision. Next week will not be that popular among dividend stocks, but we have some interesting options to suggest. Monday, 18 April is the ex-dividend date for Horizon Technology Finance Corporation and Costamare. Tuesday, 19 April is the ex-dividend date for Graham Holdings Company, Lowe's and Dell. Wednesday, 20 April is the ex-dividend date for LTC Properties and Colgate-Palmolive. Thursday, 21 April will be the most popular day of the week and is the ex-dividend date for Procter & Gamble, Williams-Sonoma, CVS Health, APA Corporation, and Designer Brands. Finally, Friday, 22 April is the ex-dividend date for Caterpillar, Pembina Pipeline and Royal Bank of Canada. Be sure to buy any of the above stocks before the market closing of the ex-dividends date previous day to benefit from the dividend payment. A few initial public offerings have been arranged for next week. Austin Gold Corporation, with ticker symbol AUST, will be listed in New York Stock Exchange American. There are about 3.3 million shares offered at a price of $4. Austin Gold is a gold exploration company focused on gold targets and making district-scale gold discoveries in Nevada. In specific, they were formed for the purposes of drilling the Kelly Creek Project, a mineral exploration project located on the Battle Mountain Eureka Gold Trend in Humboldt County, Nevada. Nonetheless, they continue to consider other regional opportunities in the event the Kelly Creek Project does not yield favorable results, and in connection therewith they have acquired 3 other non-material mineral explorations projects. Ocean Biomedical, with ticker symbol OSHA, will be listed in NASDAQ. There are 2 million shares offered at a price between $10 and $12. Ocean Biomedical is a 21st century biopharma company that partners with leading scientists and research institutions to accelerate the translation of new discoveries into breakthrough medicines. They're working to bring together the interdisciplinary expertise and resources required to develop a diverse portfolio of pharmaceutical inventions and technologies through preclinical, clinical, and commercial development. They aim to build a continuous pipeline of drug development opportunities through our relationships with universities and medical centers. If you find this video useful, please like it, leave your comment below, share to a friend and subscribe to our channel. See you next time.